Ladies and gentlemen, I've got some good news, but I've also got some bad news. We've just got a new jobs report, and this has absolutely destroyed all estimations. Now, while this is good for the economy, it's good for the middle class, it's good for you that you still have your job. Unfortunately, this is very bad for Wall Street, for the stock market, cryptocurrencies, and also the bond market. So in today's video, I'm going to break down this new report, tell you what it means for you, what it means for the markets, and I'll also have some more news, what's going on with Ford, with their huge miss in earnings and some big issues with them. I'm going to be going over Blackstone and them freezing clients' withdrawals. And then I'm going to go over one last indicator, which I haven't covered for a long time, but we all need to pay very close attention to. So everyone, this is going to be an action-packed episode, so let's not waste any time. Let's get straight into the news, the facts, and the data. Well, okay, everyone, this is what Wall Street is very, very worried about right now. It's good for you, good for the middle class, but unfortunately, Wall Street does not like this at all. So payrolls increased by 517,000 in January, crushing estimates as the unemployment rate has fallen to a 53-year low. So the economists and the experts were predicting job gains of 187,000, but we had an absolutely huge beat, 517,000. Now, this is great news for the middle class and some good news for the economy, but this is actually bad news for the markets, because what this means is it means the Federal Reserve has more room to lift interest rates. And what it also means is we're going to have more pressure on inflation. And it also means we could still have a risk, not saying it's going to happen, but we still have a risk of what the Federal Reserve is very worried about, of a wage price spiral. And what happened to the unemployment rate? It actually went down from 3.6% to 3.4%. So this is a 50-year low for the unemployment rate. But let's dig a bit deeper into this jobs report to see where the job gains are coming, and also what we all need to pay attention to, how much wages are going up, because that's something the Federal Reserve does pay attention to, and again, is worried about the wage price spiral. So this is a nice chart here. We can see this is the strongest job gains since July 2022, last year. So the biggest job gains, or no surprise, were in leisure and hospitality. They added 128,000 jobs to lead all sectors. Other significant gainers were professional and business services, 82,000, government 74,000, and healthcare 58,000. Retail was up 30,000, and construction added 25,000 jobs. So yes, while it's good we're having lots of jobs growth, unfortunately the majority of the job gains are in low paying positions. And with the cost of groceries going up, rent going up, gasoline going up, in lots of places like New York, California, etc., most people working full-time can't even survive on one full-time position because the cost of living is getting so bad. And what I think's happening with this report, why there was so much jobs gained, is we're going to have a lot of people getting another part-time job, or maybe even possibly working 2 full-time jobs just to keep up with the cost of living. But again, the biggest thing we have to pay attention to in this report is average hourly earnings and how much they went up. So let's have a look, everyone. So okay, wages also posted solid gains for the month. Average hourly earnings increased 0.3% in line with estimates, and 4.4% from a year ago, 0.1% higher than expectations. So what this report is showing us is average hourly earnings are still increasing, and they're increasing at a pace of 4.4%, double the Federal Reserve's inflation mandate of 2%, so wages are still rising a fair bit higher than inflation, and the markets were really hoping that'll go down. And this just shows you how rigged the system is. Wall Street, they want you to lose your job. They want you to earn less just so they can turn their 1 billion portfolio into 1.1 billion. They're willing to sacrifice the 99% just so the 1% can increase their portfolio by just a few percentage points. Because I was watching the mainstream media report on this news, and I'll show you a screenshot, and it's pretty funny that stocks fall after better than expected jobs growth. You'd think in a normal world, lots of jobs being gained would mean the market would rally higher. But no, in this world we live in today, the markets only want one thing: cheap money, cheap credit, and they want free money. They don't care about fundamentals. They don't care about the economy. They just want their cheap credit, and that's all. But I'm going to go over that later in the video. They're not getting that, and we're actually seeing money supply contract. Because let's listen to something the Federal Reserve said in his recent statement and something he was worried about. So Chairman Jerome Powell in his post-meeting news conference noted the labor market remains extremely tight and is still out of balance. As of December, there were about 11 million job openings, or just shy of have 2 for every available worker. And with this new jobs report, this means the Federal Reserve is going to have to do much more to bring the labor market back in balance and to also cool inflation. Again, we've had a hope and a prayer. The markets have been rallying that the Federal Reserve will pivot, that, inflation is going to go down all of a sudden, maybe halfway through this year, and then they're going to start cutting later this year. Well, no, people, I don't think that's going to happen at all. So again, this is some good news for the US worker, for the middle class, that hopefully you won't get laid off from your position. Hopefully you'll be able to keep your job. But we do have some more bad news for the markets and for some of these huge companies that reported earnings yesterday. So look at this, everyone. Ford posts full year net loss, ugly fourth quarter as execution issues plague operations. And after Ford reported these earnings, their share price dropped around 8% in after hours. So listen to this. Detroit Ford Motor reported an ugly fourth quarter, missing Wall Street's earning expectations and falling short of its own full year guidance by not just a little bit, 1.1 billion, as the company reported execution issues that plagued operations. But it just gets worse. Ford's fourth quarter net income was 1.3 billion, 11 billion lower than the same period a year earlier. For the full year, Ford lost 2 billion and nearly 20 billion off its 2021 profit. So it's absolutely crazy run. Ford, this huge car automotive company, only made 1.3 billion in its fourth quarter. Yes, to me and you, that's no loose chump change at all. But to Ford, it's absolutely nothing. This is $11 billion less than last year. Also, for the full year, Ford lost $2 billion. This is $20 billion off the money they made the year earlier. And this is what their CEO has to say. We should have done much better last year. Yes, you should have, Jimmy. Said in an earnings release, we left about $2 billion in profits on the table that were within our control, and we're going to correct that with improved execution and performance. I'm frustrated is an understatement because this year could have been so much more for us at Ford. So what caused this huge miss, everyone? Ford CFO John Lawyer said Thursday that the company's disappointing earnings were largely due to execution and supply chain management issues. The company fell short of expected sales by not a little bit, everyone, 100,000 units, equating to about $1 billion in missed earnings. And they also took some huge losses on some companies they have stakes in the EV sector. The automaker's full year results were further weighed down by a $7.4 billion loss on its 9.5% stake in electric vehicle maker Rivian Automotive and a $2.8 billion loss associated with disbanding its Argo AI automotive autonomous vehicle unit. And unfortunately, I think it's just going to get worse for Ford because as interest rates keep going up, it's going to become more and more expensive to take on a car loan. So there's going to be less and less demand for used cars as people's real disposable income, like we've been covering, has been falling off a cliff. But ladies and gentlemen, we just got some new huge news from our favorite hedge fund, Blackstone. Look at this, everyone. Blackstone's $69 billion real estate fund hit monthly redemption limit in January. So what we're starting to see with these hedge funds that brought up entire neighborhoods is investors know that the housing market is crashing and the crash is going to get worse, and they're all scrambling to take their money out, but Blackstone is saying, no, 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 no. You gave your money to us. You're not getting it yet. They faced challenges last year as more investors sought to pull money out given volatile markets. Brett hit redemption limits toward the end of last year, causing it to restrict how much investors could take out in December. So Gray has said some Brett investors have been making larger requests than they actually want to achieve in expectation that they won't receive all the money back. That might cause redemptions to be elevated at the start of the year, he said last month on Blackstone's earnings call. We think over time we'll be able to work down this backlog, he told analysts, without providing a specific timeline. So can you imagine having your life savings or your retirement fund tied up with Blackstone, and then all of a sudden you know there's going to be a catastrophic housing market crash to come, but you can't get your money out? Because everyone's focusing on the residential housing market, but we're also seeing some significant pain in the commercial real estate sector. Listen to this. Commercial real estate, which Brett invests in, has been facing challenges as a surge in borrowing costs drove down values. US commercial property prices fell 13% in 2022 alone, according to Green Street. So 13% for commercial real estate is huge. We've now got interest rates much higher, and they're going to go even higher than they are now and stay elevated much longer than the market thinks. So it's going to be more pain for the commercial real estate sector, and it's going to have domino effects on the whole economy. Now, while we did get a good January jobs report, I think, and what I've been warning about, we did get some new data, some new news that more layoffs are going to be coming. Look at this. So US employers announced more than 100,000 job cuts in January. Number of planned reductions more than twice the December level, and technology firms accounted for 41% of announced job cuts. So what's happening here is we're seeing a lot of layoffs announced in the high paying tech jobs, but we're seeing a lot of job gains in the lower paying hospitality and leisure jobs. This is up 440% from January 2022. So once the Federal Reserve lifts interest rates to 5%, we're really going to see the biggest test for how resilient this job market is going to be. Now, like I was saying earlier, we have got some new developments, this new indicator to show us there is going to be pain in the markets coming ahead. And what is that? Well, that is the money supply. We talked about extensively on the channel in 2021 and early 2022 how the money supply going up is going to cause inflation and it's going to cause a possible melt up in the markets, and that's the reason why the markets have been rallying. Well, this monetary debt system relies on more and more debt being taken on. They need continuous money being printed into the system because the US government can't afford to pay back its debt. So they need to continue to print more and more money. Because remember, they create money and then charge interest. Where does the interest come from? So let's look at this chart, everyone. So okay, this is a chart of the M2 money supply. We can see here it's pretty much gone up every single year besides tiny little dips since the 1990s. And it went absolutely parabolic in 2020, and that's why we saw a big rally in the markets. But for the first time, when we zoom in here, we can see the money supply is actually falling from around a peak of 21.7 trillion. It's now down to 21.2 trillion. But this is just in dollar terms. When you factor in real money supply growth, when you factor in inflation, it's actually falling at one of its fastest paces in decades. So look at this chart, everyone. This is the real money supply when they factor in inflation. And look how much it's dropped. Minus 7.3%. Again, we haven't seen this kind of drop since the 70s. So this means what the Federal Reserve's doing is working. They're actually taking money out of the system. But the system needs more and more money to keep on going for the market to keep on rallying. So if they don't get more money soon, we're going to see more pain in the markets, everyone. So I know what you're thinking, okay, well, what does all this economic jargon and finance news mean for you in simple terms? What this means is, everyone, with this jobs report, the Federal Reserve still has much more work to do, and I think this market rally we've seen is about to be tested. We're seeing companies' earnings come in bad like Ford, Google, Apple, etc. We're seeing the real estate market finally begin to fall because it's such a slow market to react, but that's going to have a negative wealth effect. When people see the equity in their home fall lower, they feel less wealthy, they're going to spend less. The US economy is a consumer-based economy up to 70%, so that's going to affect jobs eventually. But remember, this all has a lag effect of what the Federal Reserve does of around 6 to 12 months from peak interest rates, not while they're hiking, from after they pause. And like that chart I showed you, without the cheap money coming in, without the money supply continuing to increase, the show can't go on. But everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.